Hello and welcome to the first in a new series of videos with the aim of providing insights and updates from Saracen's asset management team. My name's Tom Santa-Olalla, Senior Associate Partner here at Saracen & Partners, and I'm joined today by our Multi-Asset Chief Investment Officer, Phil Collins. Welcome.
Thank you.
In this video, we're going to be discussing how we're positioning portfolios with regard to the latest from the US, our exposure to the tech sector, global investing in 2025, and the latest from our investment decision-making around asset allocation. So, Phil, let's start with the big picture stuff. Last year was a fantastic year for global equities, particularly in the US. And this year, economics environment is looking conducive to further growth. So how are we positioning portfolios today?
So we were overweight equities throughout last year and into this year. And that's tracked quite well. So we've been more exposed to equities, less exposed to things like bonds and alternatives. That's worked well for us as the various strategies have tracked ahead of the relevant ARC peer group. But just recently, we've trimmed our equity exposure just at the margin.
Why was that?
So Donald Trump, whilst pursuing a pro-growth strategy, has introduced a number of uncertainties into the market. So his back and forth on tariffs has meant that business leaders have a lot more to think about now in terms of whether they manufacture goods and where they sell goods. Equally, his plan to reduce the federal workforce will, we think, produce a fiscal drag of around 0.5% a year. And of course, equity valuations aren't that cheap right now.
So what are the more positive aspects of the policy?
On the more positive side, Trump is very keen on deregulation and tax cuts. Both of those things should boost growth. And of course, at the individual company level, we think there are still plenty of opportunities, be that within the fast-growing IT sector, in our digitalization theme, or perhaps less glamorous sectors like the consumer and industrials. So we think for thematic investors, there's plenty of opportunities at company level.
Okay, and what about on the tariff side of things? Do we have any concerns around the inflationary impacts of them?
Yes, we do. So tariffs are generally going to be inflationary. If we see a resurgence in inflation, then that will impact the decision-making of central banks, and they will make their own decisions on interest rate cuts. And if we don't see the sort of cuts that we were perhaps expecting towards the end of last year, then that will impact our own asset allocation decisions.
And I imagine disentangling supply chains in themselves is enough of a challenge at a business level.
Yeah, so at company level, as you know, we have a team of analysts that are very keen to look through the supply chains and work out the impacts on each individual company.
Imagine that's keeping them on their toes then.
Yes.
We mentioned the tech sector a little earlier. That's been a huge driver of economic growth across the world and a big contributor to portfolio returns, the likes of Nvidia in particular doing very well last year. However, we have seen a new entrance into the market in the AI space in the name of DeepSeek. How has that impacted your thinking around the sector?
Well, if we roll back to last year, in about the third quarter of 2024, we were busy reducing our exposure to manufacturers of semiconductors or chips. So the likes of ASML, Broadcom, Nvidia, TSMC, we reduced our exposure to all of those four companies, and we sold out of Texas Instruments completely. So all of those companies have been very rewarding for our clients, some in the quite short term, but others, most of them have been held for quite a few years. And where we were reinvesting was more in the software space. So we introduced a company called Fortinet, which is a cybersecurity company, and we boosted our exposure to Microsoft. So the software area generally we think has a lot of thematic tailwinds and plenty of room for growth. Turning to your question on DeepSeek specifically, it's not entirely clear what the implications are, but we suspect that at the margin, the makers of AI, the manufacturers of semiconductors, etc., that go in to help us make AI are marginally less attractive, whilst the users of AI are marginally more attractive. So that really would suggest that our move slightly away from semiconductors and slightly towards software last year is justified.
The US, of course, is home to many great companies, some of which you've already mentioned, but we are global investors. So what else is interesting out there in other regions?
So in other regions, as you say, we are geographically unconstrained. We care less about where a company is listed and more about where a company generates its business. So for example, Mercado Libre, which was introduced into portfolios last year, listed in the US, but generates all its business in Latin and Central America. And then moving further away from the Americas, just recently we've introduced Ferrari into portfolios, that's listed in Europe, whilst UK-listed company Compass has been in portfolios for many years and has been very rewarding for our clients.
And multi-asset investing, the clue's in the title there, multiple assets within a portfolio. They all bring something to the table, whether it's improving the income streams or providing some protection in case markets get a little bit bumpy. But with that in mind, how are we positioning within the fixed income market?
So within fixed income, we've been underweight bonds for quite some time. Up until quite recently, we've favoured bonds issued by companies over those issued by governments. But recently, the spread has narrowed in quite significantly.
Spreads narrowing, meaning that you're not being rewarded suitably for holding the higher risk corporate bonds compared to lower risk government bonds. Is that right?
Yes, that's right. So our reaction to that has been to move some money away from corporate bonds and towards UK gilts.
And what about other asset classes, gold or alternatives?
So gold represents around about 3.5% of portfolios right now. We think a very useful hedge against geopolitical bad news and inflation. And of course, we've got a good tailwind of emerging market central bankers wanting to buy gold. Beyond gold, we have good exposure to things like infrastructure, specialist credit, private equity and hedge funds.
Excellent. So all playing their part in a well-diversified portfolio. Yes. Fantastic. Phil, always a pleasure to chat with you. Thank you very much.
Thank you.
And to any clients that would like to hear more about anything discussed today, or indeed anything to do with your investment portfolio, please do reach out to your investment manager. Thank you.